All right, cool. What is the most unconventional investment thesis you've developed and why?
All right, this is going to sound like I am sandbagging, and I know that. But we have been investing in stable coins as a payment method and a savings tool for like 3 years. Now, of course, stable coins are the hot category that everybody in fintech wants to have a piece of. But one thing that we're doing that we've been doing that's non-obvious is specifically focusing on emerging markets. And so if you think about like two categories that have been like completely untouchable for VCs for the past couple of years. Emerging markets and crypto have been completely out of bounds. And that's actually where you have, I think, the most interesting opportunities for crypto and stablecoin products because you have people who live in countries without real-time payment systems, who have volatile currencies that they're trying to save money into, and who don't have banking access unless you're, in the upper class, like middle class, lower class, no banking access. Like that is the perfect situation for a stablecoin based savings or payment product to be launched. And so we have, for instance, a company called LB Finanzas in Argentina that originally built a crypto exchange. And then they were looking at how users were interacting on their exchange and said, oh, wait, most people are just buying and holding USDC. And so they interviewed 100 users, and all of their users said, look, we don't really want to trade crypto. We just want to hold our money in a currency that's going to be more stable than the Argentine peso. And so they pivoted, and now they have a savings account for consumers. They have business banking products and payments products. They're launching cards, all based on stable coins in Argentina because it gets you away from a very volatile currency in a tough macro situation. And so this is the kind of thing now where it's like becoming a little bit more consensus. But 3 years ago, nobody wanted to touch this. And I think if you look at like fundamental economics, like it makes a lot of sense why these kind of products would take off.
That is interesting. Do you think for each of the stable coins, do you think like within each emerging markets is a winner take all situation, or are there going to be multiple stable coins for different geographies you're looking at?
It's such a good question, man, and I think nobody knows the answer. And so, on the one hand, I think my impulse is to say, if you look at currency markets, there's a couple dominant currencies: USD, Euro, Yen, with like a long tail drop off of other currencies, and you'll probably see similar concentration there because liquidity matters a lot, stability matters a lot. You want to be buying things and paying for things. Sorry, you want to be buying things and selling things in the same currency as the merchants that you're interacting with, and so it makes more sense for everybody to aggregate around one currency. But unlike conventional currencies, with stablecoins, you can have easy interoperability. So like no FX fees, no time to convert between one currency and another. And so you can see an outcome where there's like government issued stablecoins, private stablecoins, and like quite a variety of different ones. And as long as like the pricing is relatively consistent, so one isn't like super volatile, I can see people holding them in regional currencies and local ones.
That makes sense. Makes sense. So specifically within fintech, what would you say are your three biggest reasons you're still bullish on the category today?
I mean, number one is just look at the financial services ecosystem. Like, look at the size of banks, funds, non-bank players, and their slowness to adopt new technology. Any market where you have giant institutions that really lag the adoption of new technology just creates opportunities for nimble competitors to provide a different service offering. That's my first reason. The second reason, and this is also going to sound like a complete canned VC answer, is that we are very early in the AI curve. And I know that AI has been kind of going through 2 years of hype. But underneath all the hype, underneath all the speculation, underneath like all the expensive rounds getting done, you're kind of getting a peek at the next platform shift in how services are going to be offered. Kind of like you had a lot of businesses that went online in the 90s and then went mobile in the late 2000s. You have a lot of products that are going to be able to leverage language models to provide something that took humans in the background before, or that couldn't be adaptive before. And that's going to change financial services. It's going to change everything from customer service to underwriting to KYC. And we're very, very early in that curve. And so even like the last 10 years of fintech, they're about to be disrupted by the next 10 years of fintech. And I think you'll just kind of see this play out over and over and over. And then the third reason that I'm bullish on fintech, and I think fintech is still 1% done, is if you look at like where fintech development has happened, it's super concentrated regionally. You have like a healthy ecosystem in the US, in the UK, in other places like Singapore, Mexico City, Dubai that are a little bit more concentrated. But this hasn't really dispersed internationally. And unlike true winner take all markets like Facebook and social media, or maybe less so Amazon and ecom, uh, fintech, because it varies so much region to region by legal jurisdiction, you really have regional winners. And so I think that there are a lot of companies that are going to be successful being built, and it'll look just like Robinhood, except it'll be Robinhood in Indonesia, or it'll look just like Chime, except it'll be Chime in Brazil. Uh, and so I think that there's still a lot more opportunity here, and we're going to see it spill across borders.
It's interesting. It's interesting. We were kind of going back and forth on this in email prior to this call, but when you think about the edge for the fund, I'm just curious how like every manager is thinking about this, but specifically you, like how are you thinking about your own edge? I guess another way to ask this is what's the elevator pitch on the fintech fund versus any other fintech seed fund out there?
Yeah, I mean, it's a good question. There's 1,000 fintech seed funds now. Um, the biggest difference with me and with this fund is that we have the media platform, which actually preceded the fund. So this week at fintech's been around for 5 years. I know we just talked about this, but we have 142,000 subscribers now. We're going to hit 150,000 at the end of the year. We have events that have been on 5 continents with close to 100,000 people. We have podcasts. We have an online community of 10,000 people. And so it's easy for the fund to leverage that to create maximal effect for our founders. And that means getting in touch with good hires quickly. It means getting your marketing messages out. It means getting you connected directly to the customers that you're trying to sell. It means introducing you to other VCs to fill out the round. I think every VC kind of talks the talk there, but we have this extremely broad and extremely deep network that we can actually leverage to do that, which other funds don't have. And then there's like the run of the mill stuff that like you should get from any fintech VC that you're going to let onto your cap table, which is expertise, long-term conviction, an ability to differentiate between good and bad within fintech, and to quickly jump on and help answer questions and unblock challenges. That's why I do pre-seed and seed. If you're a pre-seed and seed founder, like you should lean on your cap table as much as possible to help you out early on until you build a good team around you. So if you're bringing on like a generalist, to sit on your board or be your lead investor, or somebody who's like really stretched between a lot of different investments, like you're probably missing an opportunity where you could have somebody who knows more about your space than that investor sitting on the cap table, or who's more motivated to help you out, who will actually pick up the phone when you need something.
Yeah, I totally agree. I think for the media piece too, I would imagine it just makes you easier to underwrite from an LP's perspective, just because, I mean, a lot of VCs, they talk about the fact that they need to be able to make direct customer introductions to any of the companies they work with. And I mean, having 142,000 subscribers, like you're not only kind of outsourcing parts of the marketing department for these companies, but then also if they ask for direct connections to any of these people, chances are people in the fintech world have either heard of you or they're already subscribers to the newsletter. So I just feel like that's such a no-brainer from an LP's point of
That's
view.
a, that's a hope, man. I mean, if I went into healthcare and I told you I was building this week in AI, like totally different value proposition. I'm starting from the ground up, but
Yeah.
here, hopefully there's some brand awareness.
100%. Do you think was your original intention? I mean, you started earlier that you had started the media side prior to launching the fund. Was launching the fund always in the back of your mind as something that you wanted to parlay the attention into, or did it just become, I'm just curious, like how the idea for starting the fund originated?
I would like to say that there's this, 10-year master plan that I'm working against, and each step you see is a step that's been on the planning doc for years and years. But the reality is, um, I am a startup person at heart. I spent a decade working in startups, and speed matters more than anything else. And speed in my world means reacting quickly to opportunities when they come up. I was doing SPVs into fintech companies for about 2 years, and it very quickly became apparent to me that there are serious downsides to SPVs, both on the founder side and on the investor side, and that creating a fixed capital vehicle as a fund made a lot more sense. Um, when I started to put this together in mid 2021, the whole emerging manager solo GP story hadn't really begun. And then, like 3 months before I announced, Packy McCormack came out with his, and a lot of other emerging managers and solo GPs spun out and started new funds. And so now it's really a consensus bet. Everybody's a solo GP. Everybody has their own fund. But at the time, it felt very non-obvious for a media person to roll out their own fund, because it just wasn't as popular. But it really felt like this was the right opportunity at the right time, and I'm glad of the way that's worked out since then.
Yeah, I think it's genius, and I think more and more people are probably gonna follow in your footsteps. But you're an early mover. What do you think's the two-part question here? What do you think the biggest challenge and the biggest advantages of running a media company on top of the fund?
Um, it's a good question. I mean, obviously, time is a challenge. Where do you allocate it? And so the time that I put in the media company, I want to make sure it continues to pay dividends to the fund as well. And then making sure that there's a bright line between these two, like they're two completely separate businesses. Like I'm very clear with people, like when I'm talking to you, like, hey, this is actually, for media coverage or for an event partnership versus like this is for an investment. I don't want to mislead people about which conversation they're having with which business. But advantage, like these two initiatives, like totally benefit from each other. And media conversations frequently turn into investment conversations and the other way around. And so these businesses are very harmonious with each other.
Did you ever think about branding the fund as something separate, just so there was a little bit more distinction, or did you like the idea?
Yes. This, I mean, the media company is This Week in Fintech, and the fund is the Fintech Fund. Like, talk about two more uncreative names. Like, you cannot find them. It's just, I wanted to find a snappy fund name that was exciting and chic, and I just ran out of time to find an idea. And so the Fintech Fund is very much a placeholder. I actually do know what the name of the fund is going to be, starting with Fund 3 and beyond, but that's not for a couple of years. So I'm excited to finally relaunch and get out of the Fintech Fund name.
Honestly, the lack of creativity on the naming is probably a positive signal to LPs because it just shows you probably focusing on the stuff that actually moves the needle rather than just like thinking about a perfect logo and fun name. But
Hopefully.
um, kind of switching gears here a bit, but what do you think? And I'm just curious about like everybody's portfolio construction and how you think about like allocating a 15, $20 million fund. What's been your philosophy on follow-on investment, reserve ratios, especially relating to the seed fund?
Good question. So Fund 1 was about 40 companies. Fund 2 is going to be between 20 and 25 companies. So I'm getting more concentrated. And what I'm really building towards is at scale, I want this to be a fund that can lead a couple rounds, but is mostly following, and can invest from pre-seed through Series A, but it may be concentrated at Series A 1 year and maybe concentrated in pre-seed another year, but has a little bit more latitude. But I'm not there yet. Right now, it's writing the second biggest check-in rounds, and it's a follow-on investor, and we're just focused on pre-seed and seed, where I do think you have the most opportunity if you're a small fund because of the potential upside. And so the increased concentration from Fund 1 to Fund 2 is kind of one step along the route to building a better early stage fund that's able to take looks at companies across different phases of the life cycle. But it's never going to be a Series B and beyond fund. It's never going to be a growth fund. And I think if you're managing a small fund, that ends up giving you there's always like a tension between like how many shots on goal you have and how big each of those checks is against the fund denominator. So like whether one investment can return the whole fund or not. You take 100 shots on goal, sure, more of them are going to pan out, but you really have to get it right like 5 to 10 times in order to compellingly return the fund. You take too few shots on goal, like one company could be a fund returner, but obviously you really have to be a lot more diligent and a little bit more lucky with your investments. And so that plays into the reserve strategy as well. I've talked to LPs that are like, just write first checks. Like you shouldn't be having any reserves at all. And I've talked to LPs that said, like if you're investing at pre-seed, you really have no idea what's going to happen in the next 2 years. That's like the highest dispersion of possible outcomes at that point. Like you should save half the fund for reserves. So I save 20% of the fund. And the idea is basically that when you're investing at pre-seed or seed, you have very limited information to work with on a company. Maybe they have a product to market, but probably it's just like two founders in a pitch deck. When they go out for their next round, 18 months, 24 months down the line, you have a lot more information that'll tell you, hey, this is a team that we want to keep backing, or no, this is the team that we want to step away from. And that's when it matters to have reserves.
Yeah. No, 100%. So wait, where did you, I might have missed this, but where did you pan out for reserves for the current fund?
20%. I
20%.
wouldn't say it's hard and fast. It may be 18, it may be 30, but 20% is the guide.
Yeah, I think that's a good ratio. That's pretty consistent with what I've heard from some other similar size funds.
All right, love to hear it.
I guess now that you've done this, you've raised two funds on the third now, and have been in market for 5 years. What's a mistake you think emerging fund managers make when choosing how to position themselves, whether that's markets focus on portfolio construction, how they allocate operational resources for the fund, you name it. Like, is there one or two things that stand out as just glaring red flags that you think that you see other managers make?
I don't know that much about other managers, but let me talk about like some of my own early mistakes. I think it's a mistake to be too fast to say yes. Early on, what you're really doing is building a brand, and you want that brand to be as strong as possible. So be judicious with who you decide to work with and who you decide to invest in. It's okay to move slow early on. And I think that when you're an early manager and you get a fund and you have somebody else's capital to deploy for the first time, you're excited to get up and show your LPs, quarterly updates that show progress. But it's okay to take time because what LPs are buying in part is really your judgment and your sourcing ability. And so, like, if it takes 6 months to write your first check, but like you're walking people through your thought process and saying like we're going to be very intentional about who we write checks to, that's totally okay. And so I think I've seen myself be too quick to partner up with founders, and I've definitely made myself slow down. And the other thing is to just think about every investment that you are making in the context of a fund strategy. It was a big difference for me moving from SPVs to funds because SPVs you only have to return the SPV, and so it's like very binary. You either do or you don't. With a fund, you have to think about every investment in the context of the obviously like the return hurdle that you set for the fund based on how much you raise, but then what your target is in terms of DPI, TVPI, and IRR for the fund over its life. And so you need to be more valuation sensitive. You need to think about check size in the context of your overall fund strategy. And you need to be really rigid to actually holding to portfolio diversification target that you set for yourself. And this is partly like LP management. Like if you raise a fund saying we're going to invest in 15 companies and be high conviction, and then you come back to LPs or fund two and you invested in 85 companies, like it's going to raise some questions. And so I think you have to be like very thoughtful about like what role each check and each investment plays in the context of the overall fund.
Yeah, totally agree with all that. Makes a lot of sense. What's a common piece of startup advice you strongly disagree with?
Oh man, there's so many. There's so many. Probably number one is that TAM matters. Like I think early on, like pre-seed, seed, first 3 years, total addressable market is a complete fugazi. It's a red herring. It's not somewhere that you should be focused. And so that sounds crazy to say because so many people talk about total addressable market. Every founder has like a TAM slide in their deck. So why wouldn't this matter? It doesn't matter because if you have a good team that's building a good product, even if it's for like one very niche customer type, and it's a market of like 250, 1,000 customers, but you're building something that people want, and it's so clearly better than anything else that's available to them, and nobody else is building this, and you have a proprietary edge where you can actually offer this better than other people can, then you're going to convert customers. And as long as they're paying more than you're spending on them, that will subsidize you to continue growing outwards. And so like I think good product teams build their own TAMs. And the first product that you start with, Amazon started as a marketplace for books. Like what's the potential market cap of like a book specific marketplace? Okay, now it's probably pretty big, but at the time nobody was using the internet. So there were like 1 to 10,000 people max who would ever buy anything off of Amazon because it just looked like an online book marketplace for people who weren't using the internet. But of course, like their TAM changed as they grew as a company, and now it's massively bigger. But it's because they had a really good product team that said, okay, we dominated this like one niche. Now let's use that to subsidize our entry into more niches. And so I think TAM is a total distraction early on. What you should really be focused on is just building like a killer product for like one customer type and then go and build the next product for the next customer type. So when people are early on telling me we're going to be this, we're going to be this, we're going to be this, like unless like they sequence this like every 2 years, that gets me a little bit nervous.
I think that's good advice. I think it's really good advice. And then last question I got for you: are there any other emerging managers that you've been really impressed with over the last few years?
Oh yeah, so many, too many to name, honestly. Charlie Ma and Madi Raza over at shoot, I think it's called Pathlight now. They were called Exponent. I think those guys are great. I think super highly of them. Um, Nicole Wiskoff, I think, has done a really good job building her firm, and I've been impressed with her. She also kind of got her start in fintech. Um, there are other more niche managers generally. The 13 Books guys over in the UK, I think, are really smart. Well, he's not really an emerging manager, but Mark Goldberg, who left Index and just announced
Yeah,
a
I
pretty
saw
big,
that.
yeah, awesome fund, and awesome news. But he's a really smart guy who's high conviction, and so he's not like he's like a spin out, not really an emerging manager, but I think he'll do well. And then this is going to be like a little bit of a controversial pick, but I am very impressed with what Harry Stebbings has done. Um, I think he's kind of a hot topic, and it's a little bit of a Rorschach test where different people react differently. Um, but his pitch for the new fund that he raised was, Europe is a more thinly competitive VC market than the US is. And there's real opportunity here with a big brand and media company to actually go and win deals against some of the name brand firms. And I do think that that's true. I don't really know anything about his portfolio strategy with a 400 million pound fund, but I do think that he's built a really good brand that's going to help him a lot. And I apologize, I do need to jump on another call that just started.
Yeah, absolutely. Well, Nick, it's been great, dude. I really appreciate it. I'll clean all this up. I'll shoot it over to you just as a heads up before we go live with anything. But thank you again. It's been great.
Yeah, sounds good, man. Good to see you again. I'm glad life's treating you well. I will definitely look you up when I'm down in Miami next time.
Dude, yeah, let me know.
Sounds good.
All
Take
right,
it easy,
brother.
man.
Peace.
Later.